Hello everyone, it's evening here, and tonight I want to teach you about the basics of technical analysis in investing and trading. This will be an introductory lesson, so no prior knowledge about markets are really needed. And in all honesty, this is just basic pattern recognition and deductive reasoning. It's really simple. The concepts I explain are easy to digest. Technical analysis is essentially just looking at a chart and reaching conclusions based off of the information presented. That's it. I hope that you come out of this with more knowledge, or maybe you get so bored of the subject matter that you fall asleep. A quick disclaimer, this is not financial advice. It's mostly for entertainment or relaxation and education. Now you might be asking, why the topic of technical analysis? From my personal experience in learning the markets, the amount of time that you need to reach a proficient mastery in technical analysis is less time than something like learning about fundamental analysis. But that's just my subjective opinion. A lot of technical analysis that I do is through deductive reasoning and my confidence in my ability to read a chart. Everyone has intuition, and through practice that can be sharpened and utilized efficiently. It should be noted that technical analysis is important, but so is fundamental. I just heavily lean on one. I weigh about 70% of my entries from technical, 25% from market tone, and 5% from fundamental. I'd like to talk a little bit about my experience and credentials, so you know I'm not a total schmuck. I have no certification from any educational institutions or corporations. Everything I know is self-taught. I have no mentors. All my knowledge is through experience and consuming content from other traders. Anyhow, trading is my primary source of income. This is how I sustain myself. I have been trading stocks for about 5 years, options about 3, and futures about 2. I trade the S&P 500 index for futures for the last 2 years, which encapsulates 95% of what I spend trading. With the combined amount of live trading and paper trading experience I've done just with futures, I would estimate I probably have about 4 years worth of experience in just those 2 years. It should be noted, I won't be talking about trade management or the psychology of trading. Those are very, very in-depth topics that I could make a whole series on. This is just focused on technical analysis. I will be using a little bit of Mark Douglas's definitions in this video, who is a phenomenal author. Alright, let's talk about fundamental and technical analysis and get some definitions. So what are the differences between the two? You can look at fundamental as doing your research, essentially. When people tell you that, it usually refers to looking into a company or market and the data provided. You can look in the balance sheets, the interest rates, competition on their specific market, and so on to forecast a projection of the company. And if you believe you find an imbalance in data to price, then there's an incentive to buy into the asset. You have essentially done your research. Technical analysis is the insight of collective behavior into identifiable patterns. Basically, it's the lines on a chart going up or down showing the price. When we look at a chart, it shows us the historical prices of the y-axis and the time frame on the x-axis. We use these data points to reach conclusions on whether we should enter the market at a given moment. These are just parameters and a tool out of many that should be used for reaching a decision before entering or exiting a trade. Technical analysis is one of the most common tools for making financial decisions. There is a statement which I found profound and was a turning point in reshaping how I think about the markets. The quote goes something like, "Trading is just an exchange of perception, not money," end quote. Essentially, what that means is that the market is our observation and judgment on what we think other people are thinking. It's one giant massive belief propelling the price of something up or down. How we are able to sense the emotion of this mass of people will determine if we succeed or not. We are trading perception, and looking at a chart and doing technical analysis is a tangible way to plot out the will of the people. Let that sink in for a minute. Technical analysis and a chart gives you live information, which is an advantage in my opinion. When you look at fundamental analysis, there's always an idea of what could or should be. But there are times where the could and should does not align with reality. There is an inherent advantage of just looking at the price live. That being said, it is important to have a solid trading system with more than one indicator to dictate your decision making. Let's move on to the good stuff. Charting. As I explained earlier, when we look at a chart, we use it to determine historical information in order to make a confident judgment trade entry and hopefully come out with net positive income. To review, the chart we look at has an X and Y axis. The X axis signifies a time frame, and the Y axis signifies the price. The movement of the information will always go from left to right on the x-axis, which signifies ongoing time. The y-axis will always go up or down, representing price. Very simple. Put it together and it shows the change of price over time. Let's take a look at this chart and dissect how to read it. I've chosen Apple for our example today. No particular reason. I'll be using TradingView, which is a free program with excellent features. It's my personal favorite. This is called a line chart. It plots points and connects them with a line. On the top left corner, here, you can see the time frame. Currently, we are on the daily time frame, which indicates the change of price on a daily basis. You can increase or decrease the time frame to match your trading objective. For example, if you are day trading, you probably want to go into a smaller time frame, such as the hourly, or even smaller, and zoom into the hours of the day instead of the months of the year that we see here. It is important to know that the larger the time frame, the more influential the chart has over the smaller ones in most cases. For example, if you look at the chart from March 2020 to January 2022, the overall direction is pointed upwards, as we can see. Yes, there are movements downwards within the upward momentum, and there are days or weeks where it goes down, but with simple logic and of course hindsight, it would be extremely unwise and risky to make investments on the market going down while you have this perception of it going up in the long term. Everyone knows the basic chart looks like this with lines, but we are no longer basic. We're going to shift the perspective and turn on another type of chart called a candlestick chart. Candlestick charts are the most common layout for traders based on the sheer amount of useful information it gives. Think of it like this. If we were going to move to China, it would make sense to learn Mandarin. If we were going to move to Mexico, it would make sense to learn Spanish. And if we were to understand the markets, we would need to learn the language, which is candlestick charts. Now, let's take a closer look. This is what it looks like. This is a candle up close. The anatomy of one is composed of 4 parts. The high, the low, which signifies the highest and lowest price that a candle is traded during the duration of its lifespan. There is also the open and the close, which signifies the starting price of when a candle is just formed, and the close signifies the final price when the duration of the candle is over. If the candle closes higher than the open, then it is bullish, usually colored green. What does that mean? That means that in the time span of that candle, more people are willing to buy. If it closes lower than the open, then it would be considered bearish, which visually is usually seen as red. The area between the open and the close is called the body, and the area between the body and the high or the low is called the wick. To review, there is a high and low, open and close, body and wick. And that's all there is. Let's take a look at some real examples. This is the daily chart just zoomed in between December 2021 to February 2022. The candle begins to form when the day starts and finishes at the end of the day. I want to make a quick note and point out that sometimes there are jumps between candles that usually happens between the close of one day and the open of the next. Because there are orders that are sent overnight and cannot be filled until the market opens, the price can jump around when the market opens. That's why it looks like the way it does. Take a look at the one that says December 20th on the bottom, x-axis highlighted here. We can see that on the y-axis, the candle is being traded around the price of 167.5 to 170.6, with 167.5 being the low and 170.6 being the high. Since it is green, the candle is bullish and tells us that more people bought than sold. We can look at the body and see that it opened around 168.3 and closed around 169.75. We can gather all this information on how the trading day went for Apple on the 20th of December in 2021. Just one quick glance. As we zoom in or out of time frames, we can get even more detailed information. For example, I zoomed into the 30-minute chart. Each candle updates at a 30-minute interval. Highlighted here. Pretty cool, right? One caveat, as mentioned before, I will only talk about more of the basics. So if you wish to dive deeper into candles, you'll find something called candlestick patterns. These patterns are not the end-all be-all and should be used in conjunction with market tone. I would compare it to reading a room or an atmosphere. This comes with insight and experience. Think of what it takes to learn a social situation, and think about what it takes to kind of grasp that social situation in another country or culture. It is vastly different and very subjective, so you need a lot of experience. I think this is the best analogy that I can come up with at the moment pertaining to candle patterns. Now, I want to talk about trends and ranges. Trends and ranges is the meat of technical analysis for me if candles are the bone. This is a technique which utilizes to make sense of the senseless and chaos. With this, we'll be able to map out the chart and use this map as a guideline for our decision making. I cannot stress enough how powerful this tool is. It's extremely simple as well. Essentially, it's basic geometry. So let's begin. A trend is when the momentum of the market is going up or down. When the momentum is going up or being bullish, it is called an uptrend. When the momentum is going down or being bearish, it is called a downtrend. Very simple stuff. There is a technique to map out a trend and use them as a guideline for entries and exits in a trade. A range is when there is no up or down. The chart is mostly going in a linear direction. Top of a trend or range is called a resistance. The bottom called support. Now we'll be looking at a range first because it's a little bit easier to understand. We'll be looking at Apple again on the hourly chart between December 2021 to January 2022. You don't need to know much about the markets in order to see that the prices are going up and down, seemingly stuck between a set of prices. Let's draw the lines of support and resistance to get a better look. This is what we come out with. Now, what did I do? I connected the top points of contact that made a resistance. You can see the references I used circled in purple. I also connected the bottom points of contact to form support with my references circled yellow. The way I did it, I just looked at it in a way where it visually made sense. A good rule of thumb I go by is that 3 touches on a support or resistance confirms a range or a trend. And with that information, I am more confident in taking a trade. There is a dotted line running through the middle called the midline that is used as well. Think of it as a support and resistance, but not as strong. With this drawn out, you can reach conclusions on how and when to enter a trade, as well as the management of it. Again, I won't be talking too much about the nuances of actually going into trade entries, but I think it is fair to give at least 1 or 2 examples, real-world examples, and draw my own analysis. Do you see the points peeking out here at the top? To me, that would indicate that the prices tried to go higher and failed. When it fails, other people see that as not enough buyers or not enough momentum to continue upwards. So, what do? They get scared, they get cautious, and they begin to sell. See how soon after the price breaks the range and sells lower? If you were to short that area after the failed break higher, then you would have turned a profit. Think of breakouts as like a groundhog poking its head out. If it sees its own shadow, it's gonna go back down. Sometimes it doesn't, and it'll shoot up. Trading a breakout can be risky, at least for me, so I usually don't take them. Let's move on to trends. Before we talk about trends, I have to teach you about 2 things: a lower high and a higher low. These are important visual cues for analysis, and again, they are quite simple. We will look at Apple during December of 2021 again in the hourly chart. Take a look at the uptrend. See how there are periodic dips in the price as it tries to go down? This is called a higher low. What does a higher low mean in the charts? There's a low point to use as a base in this situation, right here. Now next we see a large move upwards. As a lot of people are buying into it, there may be many reasons why they're buying at that price. But let's just say for the situation, it's because it's cheap. Everyone wants to buy something at a discount, right? When it gets to a specific point of buying, people will begin to feel like they've made enough profit and start selling so they can secure those profits. This selling makes a higher low, as you can see here. Higher low is the next discounted price. It gives buyers confidence to keep the momentum upwards. We don't even need to be expert charters to see that it's going up, but with a little bit of extra skill, we can connect the higher lows and get this. It takes a bit of practice to get it right, but look at how neatly all the higher lows bounce right off the support. I drew the resistance of the trend at the top of the first high, and it ended up lining up pretty neatly. And remember how I said the midline is like a support and resistance, but not as strong. You can see it acting as that here as well. With this knowledge, you can visually predict entries and exits. And after 3 touches on the support and resistance lining up here, I can be more confident in trading this trend. This would be a good entry that I would take right here. Now for a small lesson similar to the one for the range, see how this broke higher? This means that everyone is buying in, and at this point we are topping out. Topping out means that this is the highest price it will probably go in the trend. Bottoming out means it's the lowest. This means that the party is essentially over and the lifespan of this trend is about to end. It is not always the case, but is a strong visual indicator. Look at the transition from this trend to the range that we saw previously. I have highlighted the trend blue and the range green. Take a look at the trend and how it is stopped at the midline twice, failing to make higher highs and then breaks out of the trend and into the range. Reconsider the previous trade we talked about entering in the range. Let me teach you a new concept. Counter trend trading. It means that you are entering a trade opposite of the trend. This is extremely difficult to do unless you know what you're doing. If we transition back to the previous chart, perhaps we would reconsider entering a short here because it would be counter trend trading. Sometimes no trade is the best trade. There's something to think about. We looked at an uptrend, and now let us look at the downtrend. This is the exact same concept as the up, except it's going down. Here, instead of looking for a high or low, we look for lower highs. Parts of the market where it's trying to go higher, but failing. We use that as contact points to draw our resistance. Notice how this also has a breakout of the trend similar to the uptrend. Same with the range. All three failed to break out of the direction of the momentum, and we can see that it reversed shortly after. This is not always the case, but with exposure and experience, one can use this information to their advantage. A small tidbit here, but within trends and ranges, you can also draw trends and ranges inside and trade those. Look at this as an example of the purple lines. With all this put together, we have a full picture. What I see is normal and healthy market behavior of people buying at a low cost, indicated with the blue uptrend, a consolidation of prices as people are thinking of securing profits, as you can see with the green trend, and finally, the sell-off as the party winds down, as you can see with the orange downtrend. Congratulations, you now have more knowledge of the markets pertaining to technical analysis. This is just the surface of the skill, but getting the basics down and strengthening your foundation is always the way to go. Let me greatly emphasize, when I say trends and ranges are just guidelines, they are like suggestions. All trends and ranges break out at some point or another to form new trends or ranges. They are not guarantees, and the use of market intellect, insight, and experience is required before making a decision. Here is something to think about. If people only invested off trends and ranges and no other forms of information, everyone would be rich. But that is not the case. Thank you for coming and watching all the way to the end. If you have any questions or comments, please feel free to leave them down below and I'll answer them to the best of my ability. I hope you found this relaxing, and as always, stay comfy.